Hey, hello Pooja. Hi Shraddha.
Hello, sir. Good morning.
Hello, sir. Good morning.
Good morning.
Happy Guru Purnima, sir.
Thank you, Shraddha. Okay, so let's wait for another minute if anybody wants to join, and then we can start. Pooja, I have seen your message on the WhatsApp. So I have the answers with me. So I'll share you the details after the class. Okay,
Okay, sir.
I have the explanation ready. So I'll drop your WhatsApp message after that.
Mm.
Okay, and there is one more thing. I have a question bank with me for budgeting concepts and this cost management and CVP analysis. So I would be sharing that in the group. So you are in the FMAA group, right?
Yes, sir. I
Yeah.
am.
Yeah. Okay. So we both are there.
Yes, sir.
I am not there, sir.
I guess Shraddha. Yes, sir. Shraddha is one.
Okay. So let me just check.
This is my first class.
This is your first class. Okay.
Yeah.
Okay. So this is basically Shraddha regarding pre-CMA sort of a revision and FMA kind of a class wherein let me check if you're there. I believe you are there. I've seen your numbers.
No, sir.
Okay. Okay, so what I can do, I can share the details to you over the email. I'll just share it right away so that you have the things in place.
Okay, sir.
So just give me a moment so that you can also have a quick look at that. So this is the one, right? You have? Can you see my screen?
Yes, sir.
So Shraddha, this is your email, right? So Shraddha, this is your email, right? The one which is there, Shraddha Shinde310 @gmail.com.
Yes, sir. Yes.
So you can just have it from here. Uh, there is also there. Yeah, just let me check if anybody else is also there. Currently. So this is the question bank. And what I'm going to do is I'm going to just post it in the group as well. Um, yeah, so I'll post it in the group as well after some time. So that is fine. Okay. So in the last class, uh, we discussed about the CVP analysis and okay, just give me a moment. Okay, I have to share it with Himanshu as well. So, yeah, so Himanshu, you are in that group, right? FMAA group and pre-CMA group.
Yes.
Yeah, so I would be sharing a question bank.
Okay.
You can just practice those questions over. So this is regarding section C and D. So C is basically your budgeting and D is your marginal costing and CVP analysis concepts. So let me just share that to everyone. This is your question bank section. So I've shared that. What I'm expecting is just go through the questions. So just try to go with the budgeting questions first, because there are only like 50, 47, 50 questions there. Just try to solve this. These are all the questions which are available on the portal for FMAA. So you have the correct answers there as well as the explanation given to you. Just try to solve those questions. So give yourself a 1 week's time and just try to solve that. And just if you have any questions in the next one, we are going to have a session regarding these MCQ problems. So if you have any specific question on a specific MCQ, you can always post it in the group that this question number from this chapter I am not able to solve it. We can take up in the next class. So for example, the buddy mentor sessions which I do, the people usually what they do is they solve the questions at their end. If they have any questions, they are free to WhatsApp me, they are free to email me, or they are free to post it in the group, and I give them solutions right away. So that is something which you can do as your assignment as well. So let's start the session for today. Okay. So in the last class, when we discussed about the CVP analysis, that is cost, volume, price analysis, we started with calculating the BEP points, that is the break-even points. We had a formula to calculate it in units. We had a formula to calculate the break-even point in the dollar value. And then we moved on to calculation of a few ratios. So ratios as in the contribution margin ratio, the variable cost ratio. And then we moved on to MOS, which is called margin of safety, and how this margin of safety is going to work out. There were another things which we discussed. This was regarding your expected profit. How much profit you are trying to expect. If there is a certain fixed cost you need to consider. So what we discussed is that what is the amount of profit you need to generate if you are producing X amount of units. And then we moved on to the profits of the company in case they are using multiple materials or multiple units are being produced. So we had an example which we discussed. We had A, B, these were the products. We had a proportion given to those products, which was, say, for example, 30/70. And then the point was we had to calculate a common BEP for all those products. So what you need to do is you need to calculate the contribution margin. Then you multiply the contribution margin with the weight. Then you get the consolidated contribution margin, and you have got your consolidated fixed cost. That fixed cost divided by your consolidated margin or aggregated contribution margin is going to give you your break-even point. Once you have the break-even point, you then divide it into the same ratio. So that is something which we discussed last time. So this is something which is going to be there in your examination. For FMA, this is it. Because there are multiple concepts in it which are applicable to your CMA exams. But for your FMA part, this is something which the institute is expecting from you. But there is one more thing which you need to understand, which I've been like constantly highlighting about. I just remembered, I just want to check the notes. Is basically regarding your theory of constraints. So there is one concept which is left in this CVP analysis is is how do you use the contribution margin when you have constraints. So the basic assumptions which we discussed a few classes back was that the production is equal to supply always. So demand is equal to supply, the production is equal to supply. But theoretically, it is okay. But in practical sense, uh, it doesn't work like that. The production is not always equal to supply. So either there has to be a mismatch. And because of that, we need to identify the reason as to why there is a mismatch. And that the reason is usually because of the constraints which we have. So either my labor is, I'm short on labor, I'm short on material, I'm short on electricity, I'm short on my space. There could be n number of problems with me, because of which my production equal to supply doesn't stand. So that's what we are going to just check it out. It's very basic as of now for FMAA. Yeah. So the concept is called as effective allocation of resources. So this is one of the concepts covered in your budgeting part, but it's related to your uh, contribution margin and all those stuff. So I'll tell you how that works. So what it means is that if we have limited resources, so for example, if you only have 1000 hours uh, of your labor which is available to you overall, then you need to prioritize things. You need to make sure that which product you're going to produce first. So for example, if you're going to produce 3 products with no constraints, what is going to happen is whosoever is going to give you the most contribution margin is something which you should be looking at. So for example, if A is producing $5 per unit, like this is my contribution margin, that is $5 is what I'm getting before adjusting my fixed cost. B is producing 6, C is producing 10. Because I don't have a constraint available with me as of now, I'm going to produce all of the 3 products. That is something which I can do because everybody is giving me a good contribution. But when it comes to the constraints, so for example, if we have labor constraint, that we only have a certain amount of labor hours available with us, say for example, it is 1000. So then it becomes a bit of a tricky task for me as to which product I should be prioritizing. So you need a priority list, you need a ranking list. So you need to rank the products first as to which product you need to produce based on this equation which is given to you. So there should be a contribution margin and there should be a constraint. Is it possible that you have multiple constraints? Yes, it is possible, but that is something, an advanced concept which is not there in your FMAA as of now. It would be covered in your CMA US full course, but in this FMAA, you only have a single constant theory. So you need to prioritize which product you're going to do, and for that prioritization, what you'll have to do is you need to use your constraint and your contribution margin to derive at a ranking. So let's check this out. So if you see this, it says efficient, efficient allocation of organizational resources during the budgeting process may also include making decisions about the most profitable way to utilize the resources. The decision about the product or the products to produce may need to be made under a situation of constraints. So constraint basically plays a very important role when it comes to your marginal costing. Usually what happens is without the constraint, marginal costing doesn't work in practical life. So it says that the constraint, if you see right here, the constraint exists when one or more of the factors of production are limited in some way. So they are just limited. You cannot just utilize the whole resources. So whatever you need is not available. So what I mean by that is, for example, for 1 unit of product A, you require 10 hours. These require 20 and these require 30. And if you're planning to produce, say, 100 units of each product, you need to understand how many hours are you require. So in totality, you require approximately 6,000 hours to produce all the three products with the requirements they have. But in reality, you only have 1,000 labor hours. So how are you going to manage the production of these 3 units so that you are at your optimum profit? Once you apply a theory of constraint and you have got an equation, come what may, if you disrupt that equation, you would always end up having a less profit than what is at the optimum level. Okay, so but there is one more thing to it, that this theory of constraints is only for short term. It's only for short term. It is not something which is going to be there permanently. Because if it is going to be there permanently, then it is kind of a issue with respect to the management decisions. See, the problem is you have identified a situation wherein you are crunching on the labor hours, but you cannot just continue with the same situation for years. You have to find a solution. So in short run, it is okay that you want to prioritize something, but then in long run, you should be able to produce all the things which you require. So in the long run, you require 6,000 hours of labor. For short term, you can take a decision that, okay, let's prioritize as of now, and then we can fix the labor hours issue. So what they have to do in the managers, that is the CMAs, must do the best they can with the resources. So best they can is something which we need to calculate. And in long run, however, the capacity can be expanded to reduce or eliminate the constraint. So that is something which we are working on. So it says contribution margin is sales minus revenue, variable cost. The company or division's contribution margin is an amount from sales that the company can be put forward to cover its fixed cost. Contribution margin per unit is selling price for 1 unit minus the variable cost for 1 unit. The concept of contribution margin and contribution margin per unit are more fully covered in section D, that is cost management and performance metrics. Okay, so a part of it is given in the budgeting, a part of it is given in the in your cost management or CVP analysis. So this example is something which is kind of a base of the concept, which says the Carl Corporation only has 3,000 machine hours available. So something is a constraint, that is the machine hours. So we only have 3,000 machine hours available with us to produce the products. It is operating at full capacity and can sell the products it manufactures. So whatever it's manufacturing, you can sell it. So there is a demand for the products. Carl Corporation produces two products: rack of electronic equipments and file cabinets. So these are the two main products which the company is producing. The prices and the variable cost and the number of machine hours required to produce each product are as follows. So you have been given this information. So selling price is 450, 600, variable cost is 200, 300. The contribution margin is 250, 300. So this is something which we already know, that how to calculate a contribution margin. But then what you need is machine hours per unit. So whatever is the constraint given to you, you should always have the per unit effect of that. So because machine hours are in shortage, you should know how much machine hours are required to produce a rack, how much machine hours are required to produce a file cabinet. So you need 2 machine hours and you need 4 machine hours for cabinets. So now you have to manage and decide as to what equation you are going to make so that these 3,000 machine hours which are available basically get divided in an optimum manner and you are at the best possible profit which is available based on the theory which is there. So the question is, which product should car corporation budget to produce using its available 3000 machine hours, assuming the fixed cost are same under either options. So this is a pre-assumption that fixed cost would be same, because even in the example which we discussed earlier in the last class, we had 3 columns being made, wherein there was a total column and we only calculated the fixed cost for it, right? So that's the basic assumption, the fixed costs are same for each product. So how do you do it? So what you need to do is, once you have, so if you see this, so there's a table which you can just like keep it for your exam notes or for exam purposes, is that if there is product A and product B, so in our case it is racks and files, and the contribution margin is 250 and 300. The first step would be to calculate your contribution margin per unit. So that is your first step. This is your contribution margin per unit, and make sure you have that. There could be a situation wherein you have been given the total contribution margin. Total contribution margin, you don't want it. What you want is a per unit contribution margin. And then you have got machine hours, and that should be also per unit. You don't want total machine hours. That is not required as of now. So it should be 2 and 4. And then what you need to do is you need to calculate contribution margin per machine hours. That is something which you need to calculate. So how much contribution I get per machine hour? So for that, you'll have to divide your contribution margin with your constraint. So what you do is you divide your contribution margin with your contribution margin with your constraint. So that gives you 125 contribution margin per machine hour. That is your answer, right? Whosoever is giving you the most of the contribution margin is something which you need to prioritize. So based on the information which we have, 125 is something which is contributed by racks and 75 is being contributed by your files. So based on these two figures, higher the better. So higher the better. So whosoever is giving you the highest contribution margin, that you need to prioritize. So this is your ranking. So this would be rank 1 and rank 2. Okay. Then it becomes simpler for you. So you have 3000 machine hours which are available to you. Okay. And 1 unit requires 2 machine hours, right? For rack. This is for rack. 1 unit requires 2 machine hours, and it has got the contribution margin at highest. That is something which we have already calculated, and we are using it for the ranking purposes. And we have got 3000 machine hours available with us. So the number of units which you need is 3000 divided by 2. That is 1500 units of rack you need to produce. Okay, so we can just have a look at that. Okay, since the constant is a number of available machine hours, and since Carl Corporation can sell as much as it manufactures, so I'll give you a brief on this as well, why it is saying as much as manufactured, because there is another constant. There is kind of a constant theory on this as well, which is as much as manufactured. The Carl should produce the product that provides highest contribution margin per machine hour. We know that. The rack contribution margin per machine hour is 250 divided by 2. That is 250 divided by 2. That is 125. 300 divided by 4. That is 75. even though the contribution margin for one file cabinet is higher than the contribution margin for the rack. So what it means is that when you look at the individual contribution margins, it is the highest for files. So you cannot just take that the file is something which you need to produce because you have a constraint. So you need to calculate the contribution margin per constraint. So that's what it is saying. Although the contribution margin is high, you're still choosing the rack because of the contribution margin per hour. That's what it's one. Okay. So even though the contribution margin for one file cabinet is higher than the contribution margin for one rack, since the rack has higher contribution margin per machine hour, so that is important, per machine hour, Carl should produce only racks. Rack return a higher contribution margin per unit for the scarce resource. So, and also what they have done is they have just given you the proof that how is it, like why you need to produce that. So it says using 3000 machine hours, Carl would be able to produce 1500 racks. Since each rack requires 2 machine hours, the total contribution margin from the racks during the month would be 1500. That is the units into 250. That is their contribution margin. So if I'm producing 1500 units, I multiplied by the contribution margin which I'm getting. So that is my highest thing. What if you decide that I'm only going to produce files and you just took this contribution margin as kind of your decision making factor? So how much you're going to produce? So let's check that out. That is given into you right here. Using the same 3000 machine hours, Carl Corporation would be able to produce 750 cabinets, since each cabinet requires 4 machine hours. The total contribution margin for the file cabinets during the month would be 750 into 300, that is 2,000 to 5,000. So in the short run, if there is a constraint and you have got machine hours as constraints and 3000 machine hours are available, and this is the situation which is given to you for racks and the files, you always prioritize racks to maximize your profit. So I can give you one quick example if you want to just give it a try. So let's say there are product A, there's product A and product B. The contribution margin from product A is 100, from product B is 120. So this is contribution margin per unit. Labor hours are in restriction. So the per unit labor hours required for A is say 15. This is say 10. And the max, I'll just write it right here. So max labor hours available to you is 5,000. So how do you calculate this? The first step is to go on a contribution margin to find out whether the contribution margin given to you is per unit. The answer is yes, it is given to me in per unit. Do you have a constraint? Yes, I have a constraint in labor hours. That's the maximum labor hours which are available to me. And do you have the requirement per unit with respect to the constraints? How much per unit is required? Yes, I have that as well. And my question is, what is the optimum, which product should I produce to be at the maximum profit? So the first step would be to calculate contribution margin per constraint. So it will be contribution margin per constraint. Whosoever is giving me the highest contribution margin is something which I need to prioritize, that is B. So I have prioritized that I need to produce only B. So if 1 unit of B requires 10 labor hours and the maximum labor hours available with me is 5,000. So this becomes 5,000 divided by 10. So 500 units of B I need to produce. And the maximum contribution margin per unit would be, because I'm producing 500 units and on 1 unit I'm getting a 120 contribution margin. 60,000 is my profit. Just make sure you don't use these figures to calculate your profit. This is only to be used for ranking purpose, only for ranking. You don't have to use it to calculate your overall profits. No, the overall profit still would be calculated based on your contribution margin. Okay. Now there is one twist in this. As per our calculations, okay, what is happening is we are deciding that for product B, you need to produce 500 units. That's what we decided for product B. What if we produce product B, that is 500 units we have produced, and what if there is no demand for it? Then what you do? So let's say, for example, for product B, although your answer is coming to be 500 units, the demand for product B is only for 400 units in the market. I mean, you have calculated demand and you cannot sell more than 400 units. Then how do you decide? So the steps are still the same. So there are two restrictions now. That's what we call as double theory of constraints, wherein there is a first constraint which is with respect to hours, like total units, total manufacturing capacity, and all those things. And then there is a specific demand and supply constraint for a particular product. So this calculation will still remain the same until the ranking point. Then what you do is you calculate your units which would be produced based on the information which is given to you, which comes to 500. After this, you need to check if your demand is your demand should be more than 500. That's the only case wherein you're going to produce above the answer which you are getting. So because you only have a demand for 400, this is your demand for 400. What it does is it basically disrupts your calculation of ranking. Okay, so then what you do is you calculate the revised hours. So 400, if the 400 is the demand and 1 unit requires 10 hours, so how many hours do you require to produce for B? For B, you require 10 labor hours to produce 1 unit, and you can only produce 400 now because there is no demand. Although your answer is coming to be 500, you're not going to produce 500 because of the demand constraints. So if you want to produce 400 units, you need, and 1 unit requires 10 hours. So the overall consumption of hours is 4,000. So what it does is if you have total hours of 5,000 and 4,000 hours are already being used by B, you are still left with 1,000 hours. What do you do now? Because you have 1,000 hours and you also have another product, you use that 1,000 hours to produce the other product, which is A. So for A, 1 unit of A requires 15 hours, right? So 1 unit of A requires 15 hours and you have 1,000 hours. So it would be 1,000 hours divided by 15. So this comes to 666.7. You can just round it off to the lowest number. Just make sure you round it off to the lowest number. Okay, because if you round it off to the highest number, your hours are going to get impacted. So I'll round off to the lowest number. I'll take it as 66. So I need to produce 66 of A. Every unit requires 15 hours. So that means this would be 66 into 15, 990. This would be 1,000. And you're still left with 10 hours. This would always be in balance because the answer is not rounding off perfectly. That's how you decide. For B, I'm going to produce 400 units. And for A, I'm going to produce 600 units. Come what may, given the following situation, this is your optimum solution. Your solution cannot go beyond this figures. So A is giving me a contribution of 100. This is giving me a contribution of 120. So what it does is it gives me a total contribution of 120 into 66 and 120 into 400. Sorry, 100 into 400. So this is my optimum contribution based on the constraints which I have. So there are two things which we discussed right now. Is the first one is the regular constraint, that is the total constraint which we have, which is applicable to both, and then there is an individual constraint. Any questions anybody has on this, or you just want me to repeat it once again? This would be somehow would be there in your exam, so just make sure you have a bit of a practice in this. Pre-CMA, FMAA, CMA US. For all the three, the concept that there is an advanced concept, but then the calculation will get more complicated when you add one more product to it. So if I want to add C to it, then the equation would again change to a certain extent. So let's say this is 110, this is say 20. And now you need to again decide the ranking. So ranking still remains the same. So this is rank 1, this is rank 2, rank 3. So you produce B first. If the demand is met, that's fine. If the demand is not met and you still have the capacity, you can produce A. If this is also met, you can produce C. Okay, so this is something which you need to make sure that you are aware of, and you're using for your examinations as well. Just make sure you follow a proper procedure for that. There are questions in the question bank which I have shared on this, so you can always have a look at that. The theory of constraints is something which is important, and surely it is going to come into your examinations. So let me just brief you again on where did we start and where are we right now, so that you could have a better idea. So we started with budgeting, wherein we decided, look, the year is going to start and the management requires a profit figure. Management has already concerned about how much profit we are going to prepare for the next year. Right? So we have this as a starting point. So from profit, we create our budgets. Multiple budgets: sales, purchase, production, inventory, COGS. All those budgets we need to prepare. Once the budgets are prepared, we also prepare something called as flexible budget, something called as static budget. And then based on these two aspects of the budgets, we do a budgeting of our product, of our process, of the company as a whole. So this is done. So this is something which is kind of a first and an initial step. What happens next is, once the budgeting is done, profit is decided, you have actual figures coming in month by month. Once you have actual figures, then what you do is you compare the actual figures. And this comparison is called as the variance analysis. When you compare the budget versus actual, you get a variance. You have material variance, you have got labor variances, you have got overhead variances, you have got sales variances, and all those things. There is one important thing which we discussed in the variance as well. And what was it? Even though variance is 0, you always do an analysis. Go deep and make sure that why it is 0. If it is negative, you again go deep, why it is negative. If it is positive, you again go deep and check why is it positive. So all the three scenarios, favorable, unfavorable, or stagnant, you always go ahead and do an analysis for that. Then when you have an actual figures with you to take a decision, then what happens is the actual figures are compared with the budgeting and you get a variance. Once this is in place, this is used to calculate the next year's budget. So this is something which will go on for years to years. Then once you're preparing a budget, while you're preparing a budget rather, you have to make sure that the CVP analysis is also taken into consideration because we have got constraints. Although you're telling that you need to produce 10,000 units per year, you need to make sure, do we have the capacity to produce that? If the answer is yes, that means there are no constraints. If the answer is no, that means you have a capacity constraint. And that's how this concept is linked with budgeting. And that's why it is mentioned in your budgeting chapter initially. That's how it is linked. And the theory of constraint is something which you need to practice a bit more. Okay. Then extension of this concept of your constraints, there is something called as relevant decision making. So what is happening is the CVP analysis is helping us to decide what is our BEP point, what is our margin of safety sales, what is our contribution ratio, or how much units we need to produce in order to get a certain profit. So it is helping you to take a decision. What if we have got three constraints? How can you produce the optimum profit for the company based on the three constraints? So all these things are helping you to understand that, I mean, what I mean is you need to understand this concept in such a way that it is helping the company to take a decision. And these decisions are not theoretical. These are all practical decisions wherein you quote a figure to the management. So there are a few things in which you tell to the management that what you need to do, that you give an advice. So what is the difference between advice and consulting? There is a small difference. Advice may not be numerical. Consulting is always numerical. So as a consultant or a management accountant, you should always be aware of the figures. And CVP analysis, as I already mentioned, that it is like a core of management accounting. All of the other concepts are revolving around the same, on this same theory. So it helps you to quote numbers. But then there is an additional concept associated with it. It is called as relevance. Okay, which is called as relevant costing. It's deeply covered in your CMA US course, but then you only have a chunk of it in your FMAA or a pre-CMA. So just let me give you an overview of this and we can move on to the accounting aspect of it after this. So what do you mean by relevant costing or relevance costing? So it is used to decide quickly. So it's kind of a quick decision making tool. Is it always easy to do this in practical life? The answer is no. You still require a full cost sheet to get the things through and get at a concrete decision. But if you want to decide quickly on something, then it is kind of a helpful for a quick decision. But then that decision needs to be corroborated with your detailed costing. So what it does is, for example, if you have the way you decided to join the CMA course, I am sure that you might have gone to other institutes and other providers regarding the the course material, the tutoring, and all other aspects. So let's assume that there is Uplift, and there is some other kind of a tutor. So it's others. So both the institutes are providing you with the same service, right? So let's say, so Uplift is charging you the fees, it's charging you like say $100 per hour, and others are charging you $80 per hour, or say $120 per hour. Then there is something called as material fees. Material fees. Let's say this Uplift is charging you 80, the other one is charging you 75. And then there is something called as registration fees with IMA. There is entrance fees with IMA. There is exam fees with IMA. So let's say that the registration fees charged by the IMA will be not dependent. So the fees which IMA is charging you, it doesn't depend whether you join Uplift or any other organization. It is something which is constant and will not change if you choose either of the options, right? So let's say IMA is charging you 1,000, 1,200, and say 400 for the exam fees. So if you want to decide as to what option you need to choose, what you're going to do is you're going to just sum it up like this, and you will decide, okay, there is a difference between the cost of the two institutes, which is 2780 and 2795. And if I join Uplift, you get kind of a $15 saving. That is something which this costing is going to tell you, like a very, very basic costing, adding up the total cost. But what you could have done is you would have used relevant costing as well to get a decision on this. What I mean by that is you only take onto the account the difference which is there in the costs. So if there is no difference, it becomes irrelevant for decision making. If there is a difference, you need to understand which angle you are going to use. So either you are going to use Uplift's angle or you are going to use others angle. So let's say you're using Uplift's angle. So what I mean by Uplift's angle is the view of decision making is from the view of Uplift. So if you are going to join Uplift, what is going to happen? So if you can write it this way. So if Uplift is selected, if Uplift is selected, not elected, selected, then what is going to happen? You pay 100 and you pay 120. So you're paying more for the other. That means if you join Uplift, you're saving on 120. So that is a positive sign for you. For the material fees, if you join Uplift and if you join others, you end up paying 5 more to Uplift. That is a negative sign for you then. So in all, what is going to happen is if you sum it, because all the other things are constant, they're irrelevant whether you join Uplift or others. So the cost is basically irrelevant for you to take a decision. And ultimately, the effect which you're getting is a positive 15 if you join Uplift. So it says relevant costing, if Uplift is selected, is 15 positive, which means joining Uplift is profitable by $15. That's what the conclusion is. Ultimately, this relevant costing would have a difference of the total cost ultimately. So if you see this, the number will always be the 15, the difference of the value. Okay. There is also a situation wherein you guys have done BCom, you guys have done your masters, MCom, or your 10th, 12th. So whatever cost you have already paid for studying for your 10th, 12th, BCom, is basically not relevant for me as of now, because that is something which you have already paid to different institute, different schooling, different universities. Something which is already paid, that is something which is not going out of your pocket as of now. It has already gone. It has already left your pocket. Your account is already debited. You've already incurred the loss. You've already incurred the expenses. That is something which is called as the sunk cost. Sunk cost is that cost which is not relevant for decision making in any sense. So sunk cost is called as past cost. Already paid. Something which is already paid. And it is 100% irrelevant for decision making. 100%. 100% irrelevant for decision. Okay. The way we solved this answer for if uplift is selected is also called as an incremental approach. Incremental approach. Wherein what you do is you only take the difference in the costing and you just add it up to get the final answer. So incremental approach is a technical word, but then what you do is you only have an opinion based on a selection. So first you select before getting a correct or incorrect answer. What you do is you select one of those situations. What if I select uplift? What if I select other institutions? And then you draft your answers. You draft your profits and loss based on that assumption which you have made. If your assumption is true, the answer would be positive, or you would be at a profitable situation. If the answer is negative, or you would be at a loss, that means you need to change your decision. Okay, so this is called as an incremental approach, technically, but then making it simple, it is something which you need to decide in advance, and then you go to your answer and decide whether, okay, was your answer correct? Was your assumption correct? If your assumption is correct, that means you're making the profit on your decision. If not, you need to change your decision to others. Can it be done in wherein there are 3 institutions? So the answer is no. The incremental costing usually works for 2 alternatives. So it's either uplift or others. So for example, what I mean by that is, let's say there is another institute right here. Let's say this is Hawk, and so this is Sargent. This is just a hypothetical example. And then you also have a costing to take, which you're going to take. So let's say this is 150, 100, and all the other 7 costs. So you'll have to still decide. If I choose Hawk, then Uplift and Sargent will be considered as other institutes, and all those costs will be added to them. If you select Sargent, Uplift and Hawk would be considered as others, and then you still compare with others and Sargent. That's how you need to sort of do a calculation every time. So what I mean by that is, so if I have 2, so I'll have to have others column, and then I'll have to just add the relevant cost to it, all the costs like this, and then I'll have to do a relevant costing again. So this won't be of use to you. So it again becomes the same equation. So whatever situation you have, you just have to make sure that you put it into either this or this, either uplift or others. So that is something which is there in your kind of a theoretical thing. Any questions anybody has on this? So all these MCQs are basically covered in your question bank, which I have shared. So just try to go to the question bank, try to solve the answers. The correct answers are also given there. So if you want, I can show it to you right away. So correct, incorrect answers with the proper explanations. So let's say I go to section C or D. Let's go to D. Okay, so this is the question bank. It will give you the incorrect answer as well, why it was incorrect and why it was correct. If you need more explanation, you can always tell me. I can help you with that. So for every question you have got, so the answer which is in the bold was selected, and the answer D is the correct one, which is the correct answer explanation for D. It will tell you why it is correct with all the detailed explanation. So in section D, I guess you have got 47 questions in total. Sorry, the section D has 150 questions, and section C has 47 questions. So basically 200 questions on two sections, that is section C and D. Okay, the moment you are like well versed with these questions in your homework, then I guess you should be able to solve these or crack the exam pretty easily. So the objective from now should be to understand the concept and just concentrate on those 200 questions which you have for section C and D. Okay, there would be some concepts which would be a bit more familiar to you. You have already studied that somewhere, either in your CMA, pre-CMA, buddy mentor sessions, FMAA sessions. Just take a note of that. So those concepts are important for you. So whatever concepts which are there in your question bank, if you see, there is always a concept written besides this. So it says topic is budgeting, right? So what you can do is once you're solving this, you can always have a brief understanding as to what topic is being focused by the examiner. Once you look at the question, you also can figure out what concept it is about. It's all about budgeting concepts in this one. So now it changes to budgeting methodologies, the topic. And if you see, these are all exam-based questions. These are all the questions which have already come into the exam. And it also says how many times this was answered correctly by the students. Okay, so where the percentage is low, that is something. So if you see this question was answered correctly on the first attempt by 49 students. That means this is something which is important and you need to concentrate on. Okay, so just make your list that for budgeting, you start solving the question. So what you should be doing is you just start solving the question one by one. And if you, for example, if you're stuck on this question and if you're not able to solve this properly, this question is regarding the performance evaluation based on the shipping cost, actual versus the budgeting, planned versus actual. So try to solve this. If you're not able to solve it, just mark that question as difficult for you, and then we can discuss that in the next class. Or you can just send me an email, drop the message in the group. You can always do that. Explanations are given to you. Something which you know and you're comfortable with, you can ignore that. Something which is something which is having a difficulty for you, this is something which you can always tell me. Same goes for your this section D regarding your CVP analysis. You have to just follow the same approach. The more you solve these questions and the more conceptual clarity you have on this question, you're increasing your probability to pass the exam. So if you see this, there are multiple topics given to you. You can always scroll down and check the topics on what topic it is answered to. So that is something which is kind of a homework which you need to do at your end. Okay, so if you see the pattern which is there, so there are 5 sections. So section E is regarding your professional ethics and business ethics. So that is 100% theoretical. The two things which we need to concentrate now is on the general accounting and financial management, that how a general accounting and the things are going to work. a bit of a basic concept initially, and then moving on to the other things. And then there is something called as basic financial statement analysis or financial statement preparation and analysis. So both of the things are related to accounting to a certain extent. And then we move on to the ratios. So we discuss about general financial accounting concepts. We discussed how the balance sheet, profit and loss, and other things are going to work. We'll discuss that. And we'll discuss each and every element of the balance sheet and profit and loss account. Whosoever is doing CMA, these each elements which we have, like how to adjust inventory, how to do a revenue recognition, all these are covered in your part 1 of your course for CMA US. And the second part is regarding your ratios. So the ratios is covered in your part 2 of your CMA. So something which we need to concentrate now is basically the first thing which we need to concentrate is on the accounting aspect, wherein we need to understand how the accounting works. That is a very, very basic thing. And then we'll move on to each element of balance sheet and P&L and understand the recognition of how these elements are being recognized. Once you're completed with that, we do a financial statement analysis, and for that we would be studying the ratios. Okay, we would be studying the ratios and doing a financial statement analysis. So this is your part A, this is your part B, part C is your budgeting, part D is your cost management, that is CVP. Part E is your professional ethics. This is something which we will touch at the last. This is going to take a chunk of our time as well. So what we can do is we can take a quick 5-minute break. And once we come back, we'll discuss on this. Okay, so welcome everyone again. Uh, just tell me one thing. So this is for CMA Part 2 students who are actually doing CMA Part 2 with Uplift. Did you receive the Part 2 equations and formula sheet?
No, sir.
No, sir.
Okay, so just give me a moment. I have it with me. I'll share it in the group. Okay, just give me a moment. Okay. So I'll be sharing that list right away. Because that is something which you will need before we start on this. I've told the coordinator to share it with you, but I guess I haven't done that yet. Second. Okay. Yeah, so this is the sheet basically. Can you just see my screen?
Yes, sir. But
Yeah,
not
this is
clear.
the sheet. Sorry.
This is not clear, sir.
Okay, let me just download it. Yeah, it is a bit blur to start with. So it's actually better if I email the details to you.
So now it's clear.
Now it's clear? Okay, fine.
Yes, sir.
So in mobile it is actually fine. Uh, but I guess it's the pixels are a bit. Okay, so this is the sheet. It is a kind of a very useful sheet which basically covers all your ratios and all other things at one place. And there are 4 pages to it. So this is one page. So it covers your liquidity ratios, activity ratios, leverage, capital and solvency, market ratios, and all other things. Then it also covers your CVP analysis, break-even point, total sales, like all those terms which we discussed right now. Um, there are a few things which are not as a part of FMAA, like these like payback ratios. These are not the part of FMAA, but it is good to have information if you're going to do a CMA later on. And then it covers your interest coverage, profitability ratios, risk return. So whatever ratios are there, rather whatever formulas are there in part 2, are basically being taken care by this sheet. So if you are well versed with the formulas and if you are well versed with the concepts, you should be able to clear your exam pretty wisely. So what I'll do, I'll share that in which group I am. Just give me a moment. I'll just share it right away, because what is happening is we're not getting it from the tutor. Is anybody else missing on this? I'll send you a good PDF version of it as well, but just allow me some time to do that. Okay, and okay. And I'm also sharing it in this FMA group. Whosoever wants to like have it there, you can always check it. Okay. So starting with this basic accounting and the detailed analysis of balance sheet and profit and loss account, you should first of all understand how this topic is going to be kind of be for you. I have some important kind of concepts which are there, wherein these concepts are being usually asked in the examinations, and that is something which you need to be well versed with. So the first thing you need to understand is what is the financial statement. And then moving on with the understanding of the financial statements, you also have to understand how the each elements of the financial statements are being analyzed. So, what is financial statements? That is something which basically covers your overview. It covers,
Financial position and financial performance.
yes, correct. Financial position and financial performance in the overview. Then you need to understand what is the difference between IFRS and US GAAP. So this is just a good to have information. And then what is called as integrated reporting, how this integrated reporting works. Then you have got asset valuation, wherein you need to understand how the assets are being valued. What is the definition of asset? What is the meaning of assets and all? So it says meaning, and then like how cash is valued, how accounts receivables are valued, how is your inventory valued, how is your investments valued, how is your PPE, property, plant and equipment valued, how your intangible assets are valued. So this is regarding your assets. Then you move on to your liabilities. There is a reclassification of short-term debts. That is important. There is warranties, which usually has a question in your exam because this is something which is a bit tricky to start with. Then taxation, how the taxes are being valued, and leases. That is the leases in comparison with IFRS 16. Leases is an important topic because recently there have been changes in the lease. Then you move on to your equity transactions. Wherein we need to analyze how these equity transactions are going to work with respect to retained earnings and all. Then finally you move on to your income statement, wherein you do a revenue recognition, how the revenue recognition works, revenue recognition for your contracts, like the construction contracts, how that is going to work, and income measurement. Income measurement and income revenue recognition is basically the same thing. And then you need to pitch something on your cash flows. And once you have got your financial statements prepared, you need to do a financial statement analysis, which will cover your 5 types of ratios, 5 categories of ratios. So first it would be horizontal analysis, vertical analysis, and then ratio analysis with 5 or different parameters and ratios. So this part 7 is basically your part B, and all other one is covered in your part A. So that is kind of an outline wherein you should be able to familiar with the things. So these are the ones which are important, which are usually asked in the exams. So once you're familiar with this, once you get a conceptual clarity on this, you should be able to crack the exam easily. Okay. So to understand, let's start with what is financial statements. I'm sure everybody is pretty aware of how the financial statements are and what does the financial statement do, what is called as financial statements. So what is financial statements? So financial statements are the statements wherein you present your profit and loss account, you present your balance sheet, you present your notes to accounts, and you present your cash flow statement. When all these 4 statements are being presented to the users, then it is called as the financial statement as a whole. Right? Moving on is what do you mean by revenue? Let's concentrate on this part first. Yeah. Then what is the difference between IFRS and US GAAP? So we are not concerned about IFRS as such because it's primarily a US based certification. But then it is important that you understand as to why should there be a difference. So IFRS is principle based and US GAAP is rule based. So what do you mean by principle based and rule based? Is IFRS will tell you how the principle is going to work. US GAAP would be very specific to the things. For example, according to the revenue recognition principles, it is clear that revenue can be recognized only when it is confirmed. That means if the revenue is confirmed, you have received the money and you have received and you have given all the services and everything is clear, you have to recognize the revenue in the books of accounts. Prior to that, you cannot recognize the revenue. This is given in IFRS as a general rule. But in US GAAP, for specific industries and specific companies, they'll give you a specific criteria that if line one, item number two, item number three, item number four, item number five, item number six, if you check on these points, and if this is okay, received, then you can recognize the revenue. So it is going to, IFRS is going to give you a principle. US GAAP is going to give you the rules, specific rules. That is a small difference between these two. Also, there is a difference between applicability. US GAAP is applicable to US companies and in the US. And any of the companies who is a US company but having its kind of an office elsewhere is also applicable for US GAAP. For IFRS, it is something which a non-US company usually follows. Many countries follows IFRS, UAE, Europe, all these are IFRS based. So that's like a small difference, just to good to have information too. Then what is called as integrated reporting? Integrated reporting is something wherein you combine the things. So it's similar to consolidation, wherein you have your statements as per your IFRS, you have your statements as per US GAAP. And then what you do is you consolidate the statements, you integrate the statements, and you finalize the statements based on your final principles. So there is a company in the UAE who is a US based company. In the UAE, they follow IFRS. So the accounting is basically primarily done based on IFRS principles. But then because the company's headquarter is in the USA, what the company has to do once the preparation of the financial statement is done, the company will have to adjust the IFRS financial statements in order to make it compatible, in order to integrate itself to the US laws. So that's what it means when it comes to integrated reporting. Any questions on this? So the purpose is, this is, for example, your company is working in a let's say it's in the UAE, for example, and it is kind of a US based company which you're working on. Because it is in the UAE, it is going to do an IFRS because that is something which is mandatory. But then once your financial statements are prepared and the consolidation is going to happen in the US, you need to change your financial statements with respect to US principles. Some principles are same, some principles are different. So wherever there is a difference, you always change it and integrate it as per your parent company based in the US. That is called as integrated financial reporting. Again, a good to know, a small MCQ kind of a question, nothing to be worried about. Then we need to move on to assets valuation, which is something important. So asset valuation. So the first thing which you need to understand when it comes to asset valuation is cash. So how do you value cash? So there is no valuation of cash. Cash is valued based on the actual value it has. So if you want to value cash or cash equivalents, whatever value is printed there, that is something which you have to consider. The only one control over cash is whenever there's a cash counting or there's a cash valuation taking place, you will have to make sure that it is being physically counted, because that is something which corroborates your valuation of cash. So for example, in the banks, if you say that I have 1000 cash available with me, you get it physically counted so that it corroborates your valuation. So that is only kind of a rule for cash. Cash equivalence is again something similar. The control is again sort of physical counting of the documents and confirming the value from a third party resource. Like an FD, you should always have uh, it corroborated from your bank. So bank puts the value on your FD deposits. So that's the value you need to consider as your final cash or cash equivalent for your assets. So nothing to be worried about again for cash. Then the next important thing is accounts receivables. And there are a lot of things in accounts receivable which you need to be aware of. So first thing, what do you mean by accounts receivable? Right? So accounts receivable is basically something wherein you have provided the services to your clients and you haven't received the money against that service. So what usually happens is once a sale takes place, so sale could be a cash sale or a credit sale. So in a cash sale, the accounting entry which goes into the system is cash account debit and sales account credit. So cash is coming in, sales are going out. Sales is my revenue. But then when it's a credit sales, because we don't receive cash, what you do is you debit your accounts receivables, accounts receivable. That is, you're indicating that this much amount, let's put an amount, let's say it's 100, 200 and 200. What you're telling that, okay, I have made a sale of 200, but this 200 is not yet received from me. It would be still in my accounts receivables. That means I have to receive this 200 from my customer. So it's either accounts receivable, debtors, whatever name you call it, but the treatment still remains the same. So once this entry is made into the system, there are multiple things which happen at the end. You give discounts to your customer. There are bad debts which happen. Or you can call it as a credit loss as well. Okay. And then because it is something which is uncertain now, because 200 is yet to be received, you also prepare an aging report for your debtors. So discounts, bad debts, credit loss, aging report, all those things. And the most important thing is regarding the provision. So all these 5-6 items associated with accounts receivable is something which needs to be accounted crisply so that the picture of accounts receivable in your books of accounts is clear. So how do you record these transactions? Okay. This provision, bad debts and credit loss are basically interrelated concepts, and I'll tell you how to remember it. So that and trust me, there would be a question on this credit loss. For whenever there is a question on accounts receivable, the primary focus of the examiner is always on this credit loss, bad debts and provision. Discount is something which is a bit lighter concept, can be ignored. Aging report is something which again can be just kind of a theoretical thing. Nothing, no more questions on that. But then how do you understand the difference between bad debts, credit loss, and how do you accept the provision part is something which is important. So let's understand discount first. So usually what happens is, although you have billed the customer for 200, you always want that money quickly. You don't want it to go beyond months, right? That's why you have discounting terms for your customer, which are usually 2 by 30, sorry, 2 by 30, n by 30. So these are the discounting terms you might be seeing in your vouchers if you're using this. So what it means is you get a 2% discount if you pay within 30 days, or else you pay the full amount after 30 days. Okay, that's the interpretation which it has. So 2 by 30, n by 30. What it means? 2% discount if you pay within 30 days. N means the full amount. So 2%, 2 is basically is equal to your percentage discount, and n is basically reflecting your total amount, and 30 is the time duration of discount, time of availing discount. Okay, so if it says 5 by 50, n by 50, what it means is you get a 5% discount if you pay within 50 days, or else you'll have to pay full after you cross 50 days. Okay, so that is something which you need to start interpreting it that way. Or what it does is sometimes they'll only give you this much, 5 by 50. The discounting term is 5 by 50. What it means? 5% discount if you pay within 50 days, or you pay in full if you cross 50 days. Okay, so this could be a theoretical question somewhere given to you. Then there's something called as aging report. So aging report is something, or it is a report wherein you classify your data, right? You classify your data. So there would be a report coming from the system which would look like this to a certain extent. So you would have a date. Sorry, you would have a serial number. You would have a date, name of the customer, the balance, and date of sale, and overdue days. So it would have serial number 1, 2, 3, 4, 5, 6. The date would be the today's date, right? Because you're pulling the report today. So it would always be today's date. And the name of the customer would be A, B, C, and D in E. So how much is the balance outstanding? Let's say it's 100, 200, 400, 100 again, and 150. So date of sale. So you might have a different date of sales here for each and every customer. And what it does is from the date of sale till today, it is going to calculate how many is the overdue days, right? So for example, if you sold this item to this customer A somewhere in the month of January, so this would be approximately like 6 months, 7 months outstanding, right? So I'm just taking rough figures. So let's say it's outstanding from past 210 days now. And then there would be other figures as well, like 50 days, 60 days, 90 days, 100 days. And then what you do is you make an analysis as 0 to 30, 30 to 60, 60 to 90, and greater than 90 days. So what you want now is the category of the data. So this data, which is A, is outstanding for 210 days, which means this 210 days will come here. This 180 is again greater than 90, so it will come here. This 50 is falling between 30 and 60, so this would be right here. 90 right here. 100 would again come somewhere right here. So what it does, it gives you an idea that how many debtors are outstanding with you and for how long they are outstanding. And this would be the total of your 630 would be your total. This would be again 630 coming in. So now what it says that out of these debtors, 490 are to be received from the customers to whom we have already given a service which is beyond 90 days now. That is something which you need to check on, right? You need to concentrate on these things wherein the payment has not been received for more than 90 days. You need to chase those debtors, you get the things done, you call the debtors, you send some notices and all, and get the payment from your customers. Okay, same happens with your accounts payable as well, wherein it gives you the reverse picture. The moment it crosses 90, that means you have started defaulting on your payments, and you will have to make sure that you finalize your liquidity on that. So that is something which your aging report will tell you. Okay, so it is a kind of a very useful tool, wherein in the practical life it is something which is being used like on a regular basis to track the aging of the receivables, and that helps you to get your cash flows on track. This is also associated with your accounts receivable turnover ratios and all. So in the next sort of a session, we would be discussing the ratios and all in chapter B. So this is again important for you, wherein this accounts receivable comes from or gives a life to your ratios, the account receivable ratios. Then to start with a new concept with respect to the debtors, there is something called as allowance accounting, which is a part of your bad debts, credit loss, and provision. So if you see this list, you have got 450 debtors which are not going to be received, or there is a high probability that because they have crossed 90 days now, they might default on these provisions or these payments. So what you do, because you work on a prudence principle, which says that the moment if there is a possibility of a loss, even if it is 0.00001%, you still book it as a provision. You record it as an expense, and then you can reverse it always. So you create a provision. For example, you create a provision at say 5%. So what you do, so you created a provision on the 21st of July, July gets over, then the same thing repeats for the month of August. And this provision figure will keep on changing from 24 to 25, somewhere 20, 80, whatever the percentage you have decided on. So there has to be a ratio which needs to be maintained. And that is something which is called as allowance accounting or provision accounting. So trust me, there would be a question on this provision accounting. Okay, so I'll help you with that, how you need to analyze that. What I usually prefer is making a T account, and I have my entries written there. Depending upon the question which is asked to me, I usually draw this account every time, and I have an answer in place. So you can call it allowance for credit loss account. That's the technical word which is being used in your examination. That's why I'm using it. But I also have another word for it, which is called as provision account. So or you can just call it or provision. So if you have studied this MCOM, BCOM, you would have been familiar with this word called provision. So that's why I'm using it. Even I am more familiar with this word as provision instead of credit loss account, but the question would always have a credit loss account in place. So whenever it says allowance for credit loss, it's nothing but provision or allowance for provision. So you need to understand that how this account works. Okay, every account has an opening and a closing balance, right? So the opening balance will come here. Okay. Then you've got closing balance. So it would be somewhere right here. So it's kind of a usual liability account we have, wherein, or you can call it a contra asset account. We can just write it here as contra asset. Why we are calling it as contra asset? Because it is reducing my debtors to that much amount. Contra asset account for accounts receivables. Okay. So if there is a collection, so what is going to happen is, I'll tell you, you booked a provision, right? So what you do is, because your total balance was 630 to be received, you created a provision of 24. That means what you're telling the shareholders that, okay, although I have to receive 630 from my customers, I believe that 24.5 is not recoverable now, and I'm only expecting 605 to be received. That's what you account for, and you show it in your balance sheet. But is it a guarantee? No. Could this figure be more? Yes. Could this figure be less? Yes, in real life, right? Is there a possibility that you still keep on chasing the customers and finally the customer pays it off? There is a possibility that the customer will pay off. Although you have written it off initially, there is a chance that the customer is a good customer because he was suffering from some kind of a financial trouble. He has paid you the amount. Although it is late, although you have booked a provision for it, but he has paid it in the next month. So this you did for July. Let's assume that he paid it in the month of August. That is called as collection of old provision. So there is another entry which comes here, is called collection. Okay. So collection entry goes like this. It says cash account gets debited and your allowance account, or you call it as the provision account. Provision account gets credited. Okay. So that's the entry which goes into the system. So collection of old receivables which were written off. So collection means old accounts receivable written off, recovered. Okay, so that's the entry for that. Then in the current month, that is in the month of August. So you did a provision in the month of July that got recovered. But then in the current month as well, there would be a loss which you would have known that, okay, this customer has gone bankrupt now. It is 100% that I am not going to receive a certain amount. So you pass a credit loss entry. So you pass a credit loss entry. Or you can just call it as credit loss, not entry. So credit loss is nothing but your bad debts in simple terms. This has become bad now. You're not going to receive it by any means. So what you do is you again pass an entry in the books of accounts. And what does that entry mean is you debit your provision account gets debited, but the credit goes to accounts received able account. Okay. So on the debit side, you have two entries. One is with respect to the bad debts or credit loss, and the other one is the closing balance. On the credit side, you have two entries. One is opening balance, collections, and then there is third entry which says, which is as credit loss expense. And this entry goes as P and L account debit and provision account credit. So in the actual question, you have to make sure that you are having all this information with you. So I'll tell you how the question is being framed. They'll either tell you what is the closing balance you need. Okay. So I'll tell you how the question will be framed. The first question which they usually ask you is, what is the closing balance for provision account? Okay. So to calculate the provision account's full balance, you should be having all this information in place. What you do, you have opening, you have your credit recovered if it is, so it won't be there every time. You have your credit expenses and you have your credit losses, and you have this as the balancing figure. So this one in the blue would be as your balancing figure. If nothing is given to you in the question, you can assume the things as zero. So if there is no information on the collection, you can just assume it as zero. If there is no information on bad debts, credit loss, you can assume it as zero. But these are the 5 things you will have to get a correct answer. The second prominent question which they ask you is, find the balance of collection from old receivables. For that, again, you should have all the information in place and you get an answer using the balancing figure. Okay. Same goes for your bad debts. So what are the bad debts? Again, if you want to calculate bad debt, it would be the missing figure every time. Find the balances of old receivables or bad debts. Now, the third important and the most important question is, it would be in an MCQ, and I want you guys to answer this right away, is, when I am passing an entry for collection, a collection, does accounts receivable get affected? That is the question which would come into your exam. When there is a collection of provisions for old provisions, does account receivable are affected? So look at the entry and tell me that, what do you think? So collection means this one. Once it is collected, does account receivable get affected by that? So the answer for this is,
Yes.
sorry, tell me.
Yes.
And how?
We have to return off the collection.
No. See, that's what the point is. See, the point is, because you've already written off it in the previous entry whenever you have passed it while closing it, the collection doesn't have any impact on your accounts receivable, because account receivable is neither getting debited nor getting credited.
Yeah. Got it.
Okay. Then they ask you which amount will go to profit and loss account. Which amount will go to profit and loss account? So is it the pink one or is it the yellow one, the dark yellow one, to be very fair on this one? Which of the amounts will go out of the four amounts highlighted? See, it's not about the amount, it's about the concept if you can gauge it. Which amount will go to the profit and loss account? The pink, the blue, the green, or the yellow? The answer would be this will go to the profit and loss account, not this. This will not go to the profit and loss account. Trust me. Because look at the entry. So what the point is, if the entry has profit and loss account, it is going to affect that. Otherwise, it is not going to affect it. Whatever you have studied in the past, just keep it aside. So when you're passing a credit loss entry, it affects your profit and loss account. But when you pass a bad debts entry, it affects your receivables and not profit and loss account. Amounts which will go to the P&L would be your credit loss expense and not your bad debts. Just remember this, not your bad debts. Again, the question would be, does my credit loss expense affect my accounts receivables? The answer is no. It doesn't have to do anything with accounts receivables. It doesn't have an entry there. So there's a small difference. So this is credit loss. That's why I've written it as bad debt specifically. So see this, I've written it specifically as bad debt. So you also, when you're studying it, just make sure that you treat it as bad debts and not as credit loss. So there is a difference between credit loss and credit loss expense. Okay. So there is a difference. So instead of putting it as credit loss, I always prefer putting it as bad debts. But in the exam, when the question is being framed, they'll always tell you what is credit loss and what is credit loss expense. So just make sure that you have got a specific distinction. If it is a credit loss, then that means it is a bad debt. If it is a credit loss expense, that means they're talking about what is going to go to the profit and loss account. The question is, does bad debts affect accounts receivable? Yes, bad debts only affects accounts receivable. That's the only entry which is affecting accounts receivable right here. Okay. And any questions on this? This is going to come in your exam, guys. Because there is an extension to this concept as well. So whatever the question is, just make sure that this goes into P&L. Nothing to do with accounts receivables. This is the collection amount. Again, nothing to do with accounts receivable. This is your bad debts account. It doesn't go into your P&L. The bad debts account, the amount doesn't go into your P&L. I'll tell you what it does. This is the expense amount which goes. There's a difference between actual bad debts and an expense. This goes into P&L. This doesn't go into P&L. It gets set off from your accounts receivable. So it's called as provision for doubtful debts. This is called as provision for doubtful debts. You might have heard this term, for doubtful debts. That gets set off, that will get set off against your receivables, and bad debts would get set off your against your receivables, and credit loss expense would be treated in terms of your debit to the profit and loss account. But there is one more catch into this. I know it is a bit tricky, but then just trust me, if you follow this, whenever if I'm going to tell you that does my accounts receivable are getting affected by passing a collection entry, just make sure you concentrate on the entry. If the entry has accounts receivable, it will affect it. If it doesn't have, it doesn't have. It doesn't affect. The answer is no. That's it. Now, quickly, let me just tell you one thing. Now, to calculate this, there are two methods as well. Okay. Two methods are called as percentage of credit sales and percentage of receivable amount. So, which method I am using would be dependent, would affect my calculation of provision. So, if I am using the percentage of accounts receivable amount method, what it will do, it will directly give me this closing balance. Okay. Let's say, let's take an example. If this is 1000, then this is 200. Let's assume that the collection recovery amount, let's say, is 100. So it's 1100. Let's keep it as 300. So if you calculate this, this is your credit side of 1400. And then 1400 minus 200 will give you this as a balancing figure in general. In general, this would be 1200, right? But that is normal way of doing it. So without following any of the methods, that is how the account gets reconciled. But if you want to use a specific provision method, and if you're using the receivable amount method, what will happen is you'll directly get the closing balance. So this won't be a balancing figure now. You'll get this balance, but then what happens is your credit loss expense figure becomes your balancing figure. This becomes your balancing figure. So what the question will tell you is that the company is using receivable amount, percentage of receivable amount method. What is the closing balance? So you don't have to calculate all these things. Whatever is your receivable amount, just take a percentage of it, whatever percentage is given to you in the question. You don't have to calculate this. If the question tells you the company is using percentage of receivable account method, calculate the credit loss expense, then you will have to make sure that you prepare this account and you put your closing balance right here. And then you get this as a balancing figure of credit loss expense. They might also tell you that instead of calculating a credit loss expense, calculate what is the amount of bad debts. You can still do that. But in that case, other figures would be given to you in the question. So what my point is, whenever it is a percentage of accounts receivable method, it always gives you the closing balance. And all the other things, that is credit loss, that is bad debts, collections, and credit loss expense would be the balancing figure. Or they might tell you to even calculate the opening balance. What was the previous period's opening balance? Right? Then there is another method, which is called as percentage of credit sales. Percentage of credit sales directly gives you the credit loss expense figure. And then the situation still remains the same. In that case, you have this figure coming from your percentage. The other figures can be calculated based on the balance. It's again the fill in the blanks kind of a thing. Okay. So percentage of receivable will give you the closing balance. Percentage of credit sale will give you the credit loss expense. Again, the question would be, the company is using the percentage of credit sales method. What is the credit loss expense? So just multiply it and get your answer. No need to go again in the deep. But if the question is telling you to calculate the bad debts, then again, you will have to make sure you prepare this kind of a table or an account. Okay. Any questions on this? I know I'll take an example on this in the next class. I know it's a bit kind of a tricky thing. but just make sure you have this account made, or take a screenshot of this so that you're aware of this. If you have any question, just let me know. I'm done with the class for today.
Sir, it is helpful when if we do the allowance for credit losses in number form. That
Yes, yes,
two
yes.
methods. Two methods.
Sorry, I didn't get your question.
Or two methods: revenue and credit
Yes,
sales.
yes. So there are two methods, correct?
Yeah.
No,
You have
it's not better that way. So I'll tell you, it depends on the question, how the question is framing it.
okay, okay.
So there is a possibility that the question will only give you. Okay, let me just. So there is a possibility that the question is not talking about these methods. There's a possibility that question is not talking about this method. The question is only talking about the calculation of this. In that case, the things would be given to you. But when question is talking about the two methods, that is the percentage of credit sales and percentage of receivable amount, you'll have to decide exactly what the question wants. Is question asking you to calculate the credit loss expense figure? Then it can be calculated directly. If you're using the receivable amount, and the question is telling to calculate the closing balance, then these two things can be calculated directly from the methods. So even if you are not using the method, and even if you are using the method and you want to calculate the other parts, like if you want to calculate this figure, opening balance, collection, and credit loss, not the credit loss, or the three figures, you still have to make an account and balance it out. But then you have the missing figure already with you because you know which method is being used. Okay.
Yes, sir. Okay.
Okay, if there are any questions, just feel free to ping me on the group. I'll take a practical example in the next session so that we are pretty well versed with it. But trust me, this will come in your examination, 100%. Just make sure you're familiar with it. Okay. Pooja, I'll send you your answers in a while after the class. Okay.
Okay. Thank you, sir.
Thank, okay, thank you for your time, guys.
Thank you, sir.